Hello and welcome to this special broadcast on the minutes of the last Monetary Policy Committee meeting that took place earlier this month on February 8th. The key highlights of the meeting are more or less predictable. We see the three RBI members and one external member, Shashanka Bhide, largely worried about core inflation persisting above the 6% mark. The Governor, Shaktikanta Das, is very clearly pointing out that the fall in inflation that we saw in November and more importantly in December was largely because of vegetables, which could be passing, and the one that persists, core inflation, is sticky. Rajiv Ranjan, the other RBI member, says intermittent inflation is lower, but steady inflation, which is core inflation, remains high, and therefore to bring it back to the MPC's given target, they will have to persist with the rate hike. That's how they support the rate hike. The two of them who have voted against the rate hike and have asked for a change in the policy stance, Dr. Ashima Goyal and Dr. Jayanth Varma, point out that inflation has been coming down. In fact, is lower than what the RBI forecast. They are at pains to point out that if there is over front loading of rate hikes, as Ashima Goyal calls it, the chances are that growth, which is still incipient, may be hurt. Dr. Varma basically saying that he has already made his comment in the previous policy statement, merely states that RBI erred on the side of slowly raising rates when inflation was rising. Now it is probably erring on the side of raising rates too much and hurting growth. That's the sum and substance, but we have the external members themselves joining us, so let us hear it from them. Joining me now are Dr. Jayanth Varma, Dr. Shashanka Bhide and Dr. Ashima Goyal. Gentlemen, and Ashima, thank you very much for joining us. Ashima, if I can start with you. You argue very cogently, emphatically, that inflation has been coming down. But the latest reading would make you change your mind. It's indicating otherwise.
I argued that some parts of core inflation are coming down, but I said that the headline inflation that decreased was due to could be transient volatile vegetable prices. Yeah, so yes. I agree with Rajiv Ranjan that I call it transient.
Okay.
You know, as monetary policy members, we have to look through transient inflation spike. Current spike in the latest spike which we have seen is also one of those transient spikes.
Okay.
But over the longer term, I think that firms, when they see overall some international prices have softened, some input costs have softened, and as demand is softening, we've seen that in the latest import data also, they will not be able to price on costs as aggressively. Yeah. So we should, and WPI inflation has really fallen, which captures firm prices more and their costs. Yeah. So those are the factors that I see decreasing inflation, as well as the real repo rate is positive because spreads are high, loan rates are positive, and demand is very interest sensitive in India because of the large young people buying goods on credit, housing loans being large now. So all this are factors reducing demand, and we should let this play out. This will act to damp core inflation.
Okay.
You don't need to keep raising rates if inflation is high. Okay. If you already raised them, you wait and see their effects.
Okay. Well, the argument against that, and this one is to Dr. Varma. Dr. Varma, you know, at 6.5% inflation in January, the chances are it's going to be another 6.4 in February as well. The MPC is way off target. It's not even within the tolerance band, way off target. Would that want you to reconsider your stance?
No, you see, I think the way I look at it is that, monetary policy cannot be fighting yesterday's battles and today's battles, because of the lags that are there in how monetary policy impacts the economy. You are always fighting tomorrow's battles and not today's battles. So month by month, the rate goes up, goes down. But the point is that we have done a significant amount of tightening over the last 8-9 months, and that has pushed the policy rate to a point where it is having an impact on the economy. It is destroying demand, and that demand destruction will feed through into a moderation of inflation. That's going to happen. And when you take that forward-looking perspective, then what you're really looking at is that we have done a great deal of tightening. That tightening is beginning to have an impact on the economy, and more will happen in the months ahead. And when you take that forward perspective, then what you're really looking at is that the concerns are more about growth than about inflation. There are a whole lot of structural factors that are driving the inflation down. An important element is crude. Crude has remained far below the RBI projections for many months now, and those have not been fed through into retail prices. In fact, even looking at Brent crude is a significant overestimate, because about 25 to 30% of our crude is basically coming from Russia, which is probably costing us $60 a barrel. And therefore, there is a huge amount of pass-through of the crude reduction. If the weighted average price of crude today is probably 75, and there is an enormous amount of pass-through that can happen to retail prices in the months ahead, because all those projections that we are seeing are based on 95. So there is a huge amount of pass-through that is possible, but has to happen in the months ahead, because the backlog of under-recovery will go away, and the oil companies would be flush with funds today. They're minting money at these, $60 crude prices from the Urals. That passes through, and we're going to see a very substantial decline in inflation. At the same time, where growth is going to be is going to remain fragile. That is my worry.
So are you asking for a cut in excise duties? Because the so-called $60 Ural crude hasn't flowed down to the consumer level. So are you, like Ashima Goyal, very upfront is asking for a cut in excise duties? Is that your ask, sir?
No, what I'm saying is that there is a pass-through that has to happen, right? If our weighted average price of crude is far below what it was a few months ago, then the retail price must follow, right? Retail prices follow global prices of crude with a lag. They followed with a lag when the crude went up, and they will follow with a lag when crude goes down. I'm not asking for anything. I'm simply saying
but you're saying it will come down.
In the logical course that has to happen, that when crude is costing us so low, then our pump prices cannot remain so high. There will be a pass-through that will happen, and there is an accumulated pass-through on the negative side now.
Well, actually, crude was at 121 only 1 year ago when the war broke out, barely for a month. It has fallen thereafter, but our core inflation refuses to fall. So I'll come to that point again. The supposed falling of crude-related and energy-related prices is not happening in the economy. Dr. Bhide, to come to you, what's your assessment now? On hindsight, do you think that it was just as well that Reserve Bank went with the rate hike? What's your forecast in terms of forthcoming inflation readings, since one of them is way higher than what Reserve Bank itself forecast? Reserve Bank cut the Q4 from 5.9 to 5.7. Now it looks set to be 6%, the Q4 inflation. So anything further you would like to add?
See, I think the issue really is with core inflation, because I guess the fluctuations that we saw in November, December, and probably also now in January are a few commodities, I think, which are causing these large changes. And therefore, the projections, in terms of projections, I think what is important is that the core inflation has to show moderation well below 6%. So I think the projections for the year for 23-24 are obviously below 6%, but I think that is also because of the reduction and across the board, I think expected reduction in the price increases. So I think the January figures are also not reflecting the sharp increase in prices across the board. We see large increases, I think, in wheat and so on. So,
Yes.
I think the concern is that it is important to see that there is a moderation in price pressures in most of the commodities that we see.
Yeah, actually, cereals inflation was what I was going to toss to the other members as well. Ashima, since the Monetary Policy Committee met on Feb 8, we know that the cereals inflation is up 16.2% year on year and about 2.5% January over December. We are also, in the past few days, getting data that the early onset of heat will probably reduce the wheat crop, and therefore the expected sobering of cereals prices perhaps may not happen. Your thoughts on food inflation itself?
Right. I have said that our action has to be data-based. So if all these fears materialize and wheat prices rise, there's a heat effect, and there is government action, there's sale from FCI, and the expected effect of a good winter harvest does not happen, and we think that this is going to have persistent effects on our projection, then our rates will be adjusted suitably. So our action will be data dependent. But at present, the forecasts are showing that 1 year ahead inflation is much less than 6. And our repo rate is 6.5. So that you have a real rate of 1. This is contractionary. Just remember, we have raised rates by a large amount, nominal rates, and real rates are positive 1%. And this is contractionary for demand and will work to reduce core inflation.
Yeah, the real rates, if at 6.5 and 5.6% next fourth quarter inflation, the real rate still is only 90 basis points positive. Is there not a case? I mean, there were some RBI studies which were indicating that the real positive rate should be at least 150 basis points. I mean, there was, of course, disagreement about it. But, I mean, there have been many periods in the past when positive real rate is more than 100 basis points.
But those were rates when growth slowed dramatically, when the real repo rate went to 4 and 5%, that had highly negative effect. And just remember that we are looking at a growth slowdown. Exports have slowed. There has been fiscal consolidation that reduces government demand, and other such and the effect of, as I said, interest elastic demand because of the real repo rate being positive. So therefore, there is going to be some effect on inflation from all this.
Okay, I have to take a mandatory break. Back in a jiffy with more questions for our experts. So this is an extremely interesting vote where 2 members have voted against both the rate hike and the stance. We are back.